$5,000 wasn't a prediction. It was a warning. Gold didn't crawl past a milestone. It detonated through it. In 1 year, gold jumped 84%. Silver didn't just rally, it surged more than 250%. Fact, gold crossed $5,000 an ounce for the first time in history, and silver ran nearly vertical toward $110. That is not how healthy markets move. That is how markets behave when something underneath them breaks. Here's the contradiction. This looks like a boom, but it's being driven by fear. Not excitement, not optimism, fear, inference. The market isn't pricing opportunity anymore. It's pricing escape. And this matters to you even if you don't own an ounce of metal. When capital abandons systems and rushes into assets with no promises attached, it's signaling that the rules you rely on are no longer trusted. Savings, jobs, supply chains, currencies, all of it sits downstream from this move. But here's the part nobody is saying out loud. Gold doesn't move like this unless the market believes protection is about to fail. And the question now isn't why gold went up. It's what the market thinks is coming next. What happened next didn't arrive out of nowhere. This move fits a pattern that's been quietly forming in the background. Fact. Global leaders are openly warning that the international order is breaking down. The United Nations Secretary General didn't use coded language. He said the world is sliding toward the law of the jungle. That phrase matters because markets listen when the people tasked with maintaining order admit they're losing it. But notice how little of this is being framed as a single crisis. No official declaration, no headline saying the system is failing. Instead, you get fragments. Trade threats here, military language there, ceasefires described as fragile. Inference, when instability becomes fragmented, it's harder to react and easier to normalize. This is why gold didn't move in steps. It jumped. Investors aren't responding to one event. They're responding to the realization that the guardrails are gone. The institutions meant to enforce rules are still standing, but the confidence behind them is evaporating. Here's the cognitive flip. If the rule of law is being replaced by raw power, what happens to assets that depend on enforcement, treaties, or trust? And what happens to the one asset that doesn't? That's the frame the market is using now. And once you see that, the next escalation makes sense. Here's the first hard proof that this fear isn't abstract. Fact, the US president publicly threatened Iran with a massive fleet, saying, "We have an armada, maybe we won't have to use it." That wasn't leaked. That wasn't back-channel diplomacy. It was said out loud on record and heard instantly by markets around the world. An armada isn't symbolism. It's hardware, ships, missiles, choke points. And the Middle East isn't just another region. It's where the energy arteries of the global economy run through narrow water. Inference, when markets hear direct language about naval force in that region, they don't wait for confirmation. They hedge first. Notice what wasn't said. There was no de-escalation language attached, no timeline, no reassurance, just power, followed by ambiguity. That combination is radioactive to risk models. Algorithms can price inflation, they can price growth, they cannot price an open-ended military threat. This is where the story flips. Gold didn't surge because war was declared. It surged because the possibility of uncontrolled escalation was reintroduced into a system built on predictability. The moment leaders speak this way, the market assumes things can spiral faster than institutions can respond. And this wasn't an isolated signal. It was the opening move of something much broader. And then the tension spread to a place almost no one was watching. Fact. The United States signaled possible deployment of military personnel and tariffs tied to control over Greenland. On the surface, it sounds remote. Ice, distance, geography most people never think about. But markets did, immediately. Greenland isn't about land, it's about position, shipping lanes, minerals, military reach, inference. When major powers start treating geography itself as a weapon, it tells investors the competition has moved into a new phase. This isn't posturing, it's pre-positioning. There's a precedent here, and it's uncomfortable. Historically, when nations begin securing resources and routes before a crisis fully materializes, it means they don't trust diplomacy to hold. What should be unthinkable becomes discussable. What was once extreme becomes policy adjacent. Notice how fast this is being normalized. Military language tied to trade, tariffs paired with troop deployment. These are tools that used to live in separate worlds. Now they're being blended, and when that happens, markets stop assuming restraint. Gold reacts violently in these moments because it doesn't care who controls which territory. It doesn't rely on shipping lanes or treaties. It just exists. And the more normalized this behavior becomes, the more rational panic buying looks. But this escalation wasn't finished, not even close. Here's where the contradiction becomes impossible to ignore. Fact, the US issued an explicit warning to Canada that signing a trade deal with China would trigger an immediate 100% tariff on all goods entering the United States. Not a negotiation, not a review, immediate. And this threat wasn't delivered through diplomats. It was broadcast publicly on Truth Social. Think about what that means. Canada isn't an adversary. It's a core supply chain partner. Energy, food, manufacturing, logistics. Inference. When an ally can be economically crippled by a single signature, the idea of stable trade stops existing. Notice the mismatch between words and reality. Leaders still talk about cooperation and rules-based order, while simultaneously introducing zero-sum ultimatums that bypass every traditional channel. One post, one decision, an entire continental supply chain at risk. This is the line that permanently changes how you see the market. Gold isn't rising because people want profit. It's rising because no one wants exposure. Exposure to tariffs announced overnight, exposure to trade routes that can be shut down instantly, exposure to agreements that can be nullified without warning. And once markets internalize that speed, they move faster than policy can keep up. What looks like chaos is actually adaptation, and it's about to accelerate again. While all eyes stay locked on gold, the real stress fracture shows up somewhere else. Fact. Silver surged between 225 and 252% in a single year, blasting past $100 an ounce and racing toward 110. That's not enthusiasm, that's a breakdown in pricing. Silver behaves differently because it's smaller, thinner, there's less room to absorb panic. Inference, when fear hits a market this tight, prices don't climb. They snap upward, fast, violently, with no pause. Now stack what's happening at the same time. Trade threats escalating, military language spreading, supply chains facing instant tariffs, and a market that suddenly realizes silver isn't just an investment. It's an industrial necessity. Solar panels, electronics, energy infrastructure. These sectors don't have substitutes ready. Here's the speed problem. Investors rush in, manufacturers rush in, inventories don't. That's how you get vertical charts. Not because everyone agrees on value, but because nobody wants to be last. This is the mini crisis most people miss. Gold signals fear. Silver signals urgency. One is protection, the other is desperation. And that raises a dangerous question. Now pull this out of the charts and into real life, because this is where it stops being abstract. This affects you whether you trade metals or not. Fact, silver is a critical input for solar panels, electronics, EVs, and semiconductors. When its price moves like this, it doesn't stay on a screen. It moves into costs, then into delays, then into everyday decisions. Inference, when manufacturers are forced to buy silver at any price, those costs don't disappear. They flow downstream into energy bills, into product shortages, into slower rollouts of technologies that were supposed to be cheap and abundant. The transition everyone assumes will be smooth suddenly isn't. And here's the quiet shift. Companies don't wait for confirmation. They hoard, they secure supply early, they sign contracts defensively. That tightens the market even more. What started as a financial signal becomes a physical bottleneck. You feel this as higher prices, fewer options, longer waits. Not because demand exploded overnight, but because trust in stability vanished. Systems built on just-in-time can't function when everything feels temporary. If this feels familiar, say so in the comments. Because the pressure you're feeling isn't random. It's the surface effect of something deeper, and that's where the story actually gets unsettling. Here's the part mainstream coverage skips, because it's harder to explain. This isn't just about fear, it's about incentives. Fact: markets are now operating in an environment where leverage is rewarded, speed is everything, and restraint is optional. When threats, tariffs, and deployments can be announced instantly, the system favors whoever moves first, not whoever is right. Inference: that creates a self-reinforcing loop. Leaders use spectacle to gain leverage. Markets react to spectacle, not outcomes. The reaction itself becomes the signal. Gold and silver aren't rising because everyone agrees disaster is certain. They're rising because no one believes anyone is in control. Notice how power works now. It's not exercised quietly through institutions. It's broadcast, public, performative. And once power becomes performative, stability becomes fragile. Every move invites a countermove. Every threat demands a hedge. This is why traditional models keep failing. They assume rules, they assume mediation, they assume delays. But the system has shifted to one where pressure is applied in real time and consequences are sorted out later. That's the mechanism. Not panic, not greed. A system optimized for shock. And once a system is built this way, it doesn't slow down on its own. It accelerates until something forces it to stop. From here, the market is staring at two paths, and neither is calm. Fact: analysts are openly saying this rally is no longer short-term speculation. It's being described as a global recalibration. That language matters because it signals duration, not a spike. One path is stabilization. Tensions cool, threats pull back, institutions regain some authority. Inference: if that happens, gold and silver don't crash, they consolidate. Because once trust is damaged, it doesn't fully reset. A higher baseline becomes permanent. The other path is acceleration. More trade ultimatums, more military signaling, more policy delivered through surprise. In that scenario, metals don't just rise. They reprice again, not gradually. In steps, each shock setting a new floor. Notice what's already happening. Selling pressure is modest. People aren't rushing to take profits. That tells you the market doesn't believe the risk has passed. It believes the next move is already forming, just off camera. This is the uncomfortable part. The future isn't being decided by a single event. It's being shaped by momentum, by habits, by how power is exercised now, and momentum doesn't ask for permission before it moves. Here's the insight that ties all of this together. Gold at $5,000 isn't the story, it's the symptom. Fact: markets are no longer reacting to data points. They're reacting to behavior, to how leaders speak, to how fast threats are made, to how easily rules are bypassed. Inference: when behavior becomes unpredictable, value migrates to what doesn't depend on behavior at all. Gold doesn't need treaties. Silver doesn't need trust. They don't care who posts what or when. They just sit outside the system while the system argues with itself. This isn't a panic, it's a recalibration, a silent vote by the market on what it believes will still work when everything else feels conditional. And that's why 5,000 doesn't feel like an end, it feels like a reset point. The real story isn't how high prices went, it's why nobody wants to sell. And if you want to understand what comes next, before it shows up in headlines, that's what this channel is here for.